听见资本本期视频为您带来的是太平洋投资在4月3日闭门会，主题为固定收益成为稳定之锚。全球经济正进入一个充满不确定性的新阶段，各国似乎更倾向于刺激国内需求，但并非所有国家都有足够的财政空间来缓冲经济冲击。就有的美国例外论正受到质疑，国家利益优先正在成为新主题，这背后是长期存在的全球贸易失衡问题。一些国家通过抑制国内消费，补贴制造业来维持顺差，导致美国等逆差国制造业空心化和财政赤字增加。现在美国试图通过关税等手段强制再平衡，但这会带来混乱，短期内通胀可能飙升至 3% 甚至 4%， 同时经济增长却可能停滞，消费者实际收入和企业利润受到挤压。这对美联储来说是个大难题，一边是通胀抬头，一边是衰退风险加剧，他们降息的空间可能受限。市场对此反应剧烈，对大幅降息的预期已经降温。那么在这样动荡的环境下，投资该如何应对？讨论认为，固定收益因其稳定性和当前收益率而凸显价值，但信贷市场尤其是低质量领域可能存在风险，需要警惕。相比之下，有优质抵押品支撑的资产担保融资或许是更安全的选择。同时，全球央行政策分化也带来了跨国界的相对价值机会。接下来是英文会议的全部内容。如果您需要我的投研助理人工校对的中文文本，您可以在频道的 Patreon 上获取。
has shown more willingness to stimulate their household sector, and we think that's going to be a theme as well. One important caveat to that is not every country has the fiscal space to sort of pad their economy. So places like France or the UK, for example, don't have as much fiscal room.
All right, before we unpack those themes a little bit further, I think it would be helpful just to update everyone on where we stand for a few key economic indicators. You mentioned a little bit of this, but at the beginning of the year, we've seen some encouraging data, and then we're starting to see somewhat of a shift with all the uncertainty and new administration and new policies coming into play. Where do we stand today?
Yeah. So I think it's worth talking about initial conditions. So how do economies stand when they come into this period of potential disruption? And there I think there's the good news is that they're pretty good. So the pandemic-related disruptions that we've seen are really well behind us now. Inflation is at or within a stone's throw of central bank targets. The labor market adjustment as a result of more acute labor shortages post-pandemic, that's really taken place more fully. And as a result of that, before this, we had central banks that were normalizing policy. They were basically readjusting monetary policy with a lag to these more normal economic conditions. And I would also just emphasize that in the United States, consumer and business balance sheets, private sector balance sheets are actually in a really good position. So the pandemic was unique in that people came out of it in a better position than when they went into it. You've had wealth gains that households are enjoying, and maybe outside of some pockets within the business sector, that we and many have talked about within the private credit markets, business sector balance sheets are also incredibly strong. So the good news is we come into this period in a good position.
All right, let's maybe unpack some of those themes that we touched on a little bit. Global uncertainty, U.S. exceptionalism coming under question, and really this shift in priorities towards national interests. What were some of the discussion points?
Yeah, so clearly we have a new potential disruptor. And we would argue these various policy pivots, the three that I mentioned, they really all kind of, come back to the interconnected issue of global trade imbalances. And just on trade, I think it's reviewing the administration's logic here, whether you agree with it or not, because I think that helps put some of the additional policy discussion that we're hearing out of Washington into focus. And here, basically what the administration would argue is that efficient market mechanisms should effectively balance trade over time. So an example of that is if you have a country that has a competitive advantage in some product or service, they'll export, they have an initial trade surplus. But as a result of that, they also are getting higher domestic incomes from all of those profits coming back in the country, and they consume more. And as they consume more, they import more things. You probably also have a currency adjustment and appreciation that's happening, and over time that helps rebalance trade. So you effectively are exporting to import. But if you look at the last 40 years of trade within the global economy, what you see is that mechanism clearly has not happened. So we have countries that have effectively run serial trade surpluses, China, Japan, maybe before the pandemic, also places like Germany, Korea, Singapore, against other countries in the global economy that run serial trade deficits. That's the United States. But also you have countries like the UK and France that do as well. So, there's a key question around why is that happening? Why are we not getting that rebalancing? And the administration would argue it's because of policies, regulatory, other sort of structural policies within these trade surplus countries that effectively depress consumption. They require their household sector to subsidize manufacturing. And so the result of that has been places that don't do that, like the United States, they can't compete. And we've had a hollowing out of the middle class. We've had a reduction in manufacturing share in the United States because we can't compete with this. As a result of how the government social safety net is set up, that's resulted in, automatic stabilizer type of programs that have increased the U.S. federal fiscal deficit. So things like Medicare, food assistance programs, U.S. disability programs, all have had increased pickup as a result of what economists call this a China shock. So as you can see, as I'm talking, these are structural issues that require structural adjustments that will be difficult. And I think that, just puts in perspective the broader discussion that's happening in Washington around really cutting federal government spending and fiscal deficits. It's not surprising. They're talking about Medicaid. They're talking about SNAP. They want to reduce education. We're looking at reducing federal government workforce. There have been lots of job reductions within the VA and other places like that, that help out with some of this disability insurance. So, though they're trying to make those adjustments, like I mentioned, they will be politically difficult. Things like the DOGE related stuff looks like it's running up against some legal constraints. But the U.S. is not the only place that needs to make these adjustments. Elsewhere, China, other places also need to make those adjustments. The U.S. is trying to force that through higher tariffs. That's creating some disruption. And, it's really yet to be seen how much additional price level adjustment, how much additional market volatility the U.S. voter base is willing to tolerate to get through this period. So I think all of this is to say is that these structural adjustments, they have important constraints, and that's just creating a lot of near-term uncertainty.
Yeah, I think about all the great work that you do as well as Libby. If we think about Washington and economy coming together, there's just a lot of uncertainty there. We've made it this far without talking much about the Fed. So let's touch on that. What's the outlook for the Fed? It's still so top of mind for many investors.
Yeah. Well, maybe I'll be actually relatively brief here, but I think the bottom line is all of this puts the Fed in a really tricky position. So these tariffs, they will result in a price level adjustment, but that will cause near-term inflation, and we think inflation could rise above 3%, maybe even 4%, if all of the stuff that is being talked about is implemented on the trade side. At the same time, you could have growth, though, that is being reduced to kind of a stall speed. These things will weigh on growth. Real incomes for consumers, corporate profits for businesses, they will be squeezed through all these policies. And there's a real question on the potential for labor shedding. And of course, all this is coming in the context of immigration policies, which we haven't discussed either, that's limiting labor supply. So all of this is to say is that the Fed has some tricky decisions that they're going to make. We think it really will boil down to, are recession risks rising faster than inflation risks? And on this point, I would say that it has been recently a very uncomfortable increase in inflation expectations across the various consumer surveys and business surveys more recently. And this could eventually constrain the Fed. It's obviously going in the direction they don't want it to go. We think what it means is the more preemptive cuts that the Fed did in 2018, 2019, for example, against potential weakness, they could be more constrained in that. But nevertheless, if they're seeing the unemployment rate increase, we think they're cutting aggressively as those recession risks are increasing.
Mo, this is actually probably a great opportunity to bring you into the conversation because we've seen that shift taking place in terms of just market pricing on the pace or the potential pace for cuts. What have you all seen on the desk?
Yeah. So I think, as Tiffany mentioned, more surveys have pointed towards increased inflation expectations. When we look at the market pricing, it is also reflecting a higher or an increase in inflation premium or inflation expectations in the front end. On the other side of it, when we look at the implied probability of a greater than 100 basis points rate cut, which can happen in a recessionary scenario, that implied probability of that kind of cut has fallen quite meaningfully. So what that means is that in this period of uncertainty, should the growth weakness scenario or a recessionary scenario get realized, the probability of which is also increasing, there is plenty of room for the Fed to cut rates, which is one of the reasons why we have been running a little bit overweight duration as a scenario hedge to a more risk-off scenarios. But certainly market pricing of a significant rate cut has come down quite significantly.
So a real tug of war just between inflation expectations, growth worrisome, and recession risks. Tiffany, thank you. Mohit, let's turn fully to our investment implications, building off those macroeconomic themes. In an environment of, frankly, just ongoing uncertainty like today, what investment implications did we cite?
Yeah. So I think before I go into the investment implications, the three key macro takeaways. First is just this elevated level of uncertainty. Second is shifts with respect to expectations of U.S. exceptionalism. And then third is a little bit more shift towards deglobalization, more shift towards inward-looking policies. So what are the investment implications in a highly uncertain world where you have a little more deglobalization happening and where U.S. exceptionalism may not be as it was in 2024? I think the first and the foremost implication for us is the stability that the fixed income offers in investor portfolios. We've been running overweight interest rate risk in our portfolios since the beginning of the year. At these valuations also somewhat overweight, not to the degree that we were 3 months ago. Some overweight still makes sense. And I think with the incoming data, we will continue to adjust that positioning. The second aspect is recognizing that in this environment, the central bank policies will be less synchronized than they have been in the past. In the last 3 years, as rates moved higher, they moved higher in a more synchronized manner as most central banks were addressing inflation outcomes. Going forward, we expect a little less synchronized output from central banks. And what that does is it creates attractive relative value opportunities on the global space. We find value in Australia, we find value in UK, but in general, more opportunities there. And then the third is that, when we look across credit markets, we find some areas of complacency in investor behavior. And that's what makes us a little bit concerned about the opportunity set there. When we look at, say, for example, the floating rate market in the public broadly syndicated loan, as well as in private corporate credit, we see that those signs of complacency. So for us, the alternative where we can get stability, where we can get the stability of returns without being subjected to undue downside is in the asset-based finance space, where the collateral quality is much stronger. So the three main investment implications for us are the value in fixed income, global opportunity set, and then within the private space, focusing more on the asset-based finance relative to private corporate credit.
So we're going to dig deeper on that first theme of just value in fixed income. And you mentioned this a bit about just this U.S. exceptionalism. Tiffany mentioned this about it coming into question. How are you thinking about recent market movements and what that means for bond investors?
Yeah, so I think in the last few months, central markets have been questioning this theme of U.S. exceptionalism. For us, from a portfolio point of view, we had been running a little bit underweight European duration and an overweight to U.S. duration. That certainly has performed, particularly in the month of March, as Germany has had to do larger fiscal. I think on a go-forward basis, as European yields move higher, it'll be an opportunity to add some exposures there as well, particularly in the front end where you are not as much subjected to higher deficits and higher issuance. Outside of the government bonds, I think opportunities in corporate credit in Europe, particularly pertaining to sectors like defense, capital goods, industrials, and even financials would be an opportunity for us to kind of take advantage of. But even beyond that, I think if we just take a step back, broadly speaking, with this all this uncertainty, questions around U.S. exceptionalism, the opportunity set in fixed income looks quite a bit more attractive. I think when we compare it versus equities, expected returns in equities are now similar to the yields that we are getting in fixed income. So for investors, it makes a lot more sense to get that stability in fixed income relative to kind of the uncertainty in equity space. So that's kind of another area for us to focus on, recognizing that the yields have moved higher. And then the third important thing for us is just this idea of correlation. I think in this kind of environment, particularly whenever we see a more risk-off event, more stress events, as we have seen in the last couple of years around Silicon Valley Bank, around the Japan carry unwind, and then more recently in the last 3 months around the US equity weakness, we have seen fixed income provide positive returns. So certainly that inverse correlation aspect of fixed income in the versus risk assets provides a further source of value for investors to consider in their broad portfolio context.
Yeah, I think, the key objectives of bonds seem to be much more attractive today and working as you would expect. Capital preservation, equity diversification, and then you touched on the yield piece, which is a good indicator for forward-looking returns. You mentioned global opportunities. What are we seeing there with respect to opportunities outside of the U.S.?
Yeah, so I think when we look at yields globally, there has been a meaningful repricing across the globe. I touched upon it very briefly, that repricing happened in a lot more synchronized manner as the central banks across the globe were tasked to address the inflation issue. So most central banks did hike rates. So we have seen kind of a pretty significant increase in yields across the globe in various assets. On a go-forward basis, I think the trajectory of central bank outlook will be less synchronized. And that's very important here because each country, and particularly in this environment where each country is focusing on more inward-looking policies, less globalization, more deglobalization, the trajectory of rate path in the different countries will vary. So for us, that's a big source of value creation. What have we been focused on? I think we touched upon the European rates aspect. As the European rates move higher, there'll be an opportunity to add exposures there. But also important is that this will, the massive fiscal that Europe has to do. What that would mean is a little bit steepening in the yield curve. So another opportunity would be a yield curve steepener in Europe. Contrast that to Japan, where essentially what is happening is Japanese central bank is having to deal with inflation that is moving higher above relative to their target. So they have to raise rates, whereas the backhand has already repriced quite meaningfully. So the opportunity in Japan, in addition to rates, is in a flattener space. So what you're seeing is a lot more relative value, not just in the duration space, but also on the relative yield curve across different countries, depending upon the outlook for central bank policies.
All right, let's take a few favorite asset classes in turn here in pretty short order. Starting with inflation, what's our view on TIPS, Treasury inflation protected securities?
Yeah, so I think from a TIPS, our view essentially is that broadly speaking, over the next 3 to 5 years, we think it's more likely that inflation realizes above central bank's target. Market pricing reflects closer to 2% inflation break-evens. So having a little bit of an overweight TIPS in portfolios makes a lot of sense. Particularly, it protects the portfolios against a scenario where inflation persists somewhat higher than central bank's expectations. Additionally, I think the real yields in TIPS, they have moved meaningfully higher since GFC. They're now at around 2% or even higher. So what that means is that even if a negative growth scenario gets realized, you could see real yields moving lower that could provide upside or value for investors. So certainly, I think in this environment, having some TIPS in the portfolios makes a lot of sense.
All right, and let's look at spread markets and credit. What are driving spread markets today? What are the risks and what opportunities do we see?
Yeah, so starting with the opportunities, and I'll start with one opportunity that is a little bit outside of credit, but still a spread product, which is in the agency mortgage space. I think agency mortgages meaningfully underperformed post Silicon Valley Bank, and they provide a really good opportunity in portfolios. First in absolute space, but also relative to corporate spread in this environment, because they are not going to be negatively impacted by this ongoing tariff headlines. So that's one area within the spread space that we think investors can get high quality spread, but at the same time not be subjected to the tariff volatility. So that's one. Then when we look at the corporate spread space, broadly speaking, what we have observed is the level of spread has continued to tighten across all areas of spread markets. But on the other side of it, what we are seeing is that basically the quality is deteriorating in the lower quality segments of spread markets. And I'm talking about more floating rate issuers. I'm talking about private corporate credit, even more levered high yield space. But on the other side, the high quality investment grade, as well as broad high yield, the quality has been improving. So for us, the opportunity in the credit space has been to go up in quality, more higher quality space, more investment grade, select high yield, focus on sectors that will not be impacted by tariffs, like financials, like utilities, and at the same time recognize that complacency in some of the lower quality segments and be ready to take advantage of opportunities as they get created, similar to what we are seeing in the last few weeks.
All right, Mohit, a final investment application. We favor asset-based finance relative to corporate credit. And this is across both public and private lending. Help us understand some of the dynamics at play right now in that market.
Yeah, so I think what has been a dynamic has been a lot of investment flows have gone into private corporate credit in the last few years, given the floating rate nature of that asset. However, when we look at the underlying fundamentals, there is a reason for us to believe be a little bit more cautious there. What are we seeing? We are seeing default rates pick up, and that is happening in an environment when economic growth so far has been strong. We're also seeing increase in the payment in kind activity, which is somewhat negative for future returns. And then we're also seeing an increase in companies with much lower fixed charge coverage ratios, meaning companies who are generating enough cash flows to pay their interest expense. So the number of companies not generating enough cash flows is increasing. Contrast that to the asset-based finance, where what we are seeing is quality improve, where we are seeing delevering on the consumer side. And then finally, the asset value through, for example, aircraft, through data center, through equipment, in addition to housing, can provide a really good downside protection in an environment when growth is weaker. So much stronger, much resilient relative to corporate credit.
All right, before we move to a couple of client questions, let's highlight a few of the key takeaways. First, times of disorientation can create opportunities for growth and reinvention. Fixed income allocations are well suited today to act as stabilizers in portfolios. Bonds are positioned to deliver value and diversify products because of their higher starting yields. Active, global, and flexible management, harnessing PIMCO's full platform, will support strong alpha generation as we move ahead. Second, it's essential to find relative value during times of volatility. In more volatile environments, complacency can be risky for investors, especially those who believe that past stability will continue. We recommend that investors keep it simple by focusing on high-quality fixed income. These investments provide important downside protection. And third, we recommend focusing on areas with the most relative value. This includes high-quality fixed income, securitized products, and asset-based finance strategies, as well as identifying value in select emerging market opportunities. PIMCO is well equipped to navigate these complexities, and we remain focused on helping you put the right strategies in place to capitalize on the opportunities ahead. All right, let's finish with a couple of questions. We're going to do these pretty quick. All right, Tiffany, first question for you. I like this one. What probability does PIMCO assign to a stagflation scenario occurring?
Yeah, so I think that the discussion that we've been having clearly has a whiff of sort of stagflation. But I guess what I would just highlight is that I think the more formal definition of stagflation is accelerating inflation during a recession. The thing that we would just emphasize here is that although we are getting some potential price level adjustments related to tariffs, in the event that we did have a recession, that would ultimately result in inflation coming back down. We do think the Fed would be cutting aggressively. So maybe that's a long-winded way of saying is like still reasonably low.
Not zero, but not very high.
Yeah.
Okay. How about a chunky one for you, Mohit? Here, a lot of talk on privatization and reforms around Fannie Mae and Freddie Mac. What are our thoughts there, especially in the context of our overweight to agency mortgages?
Yeah. So I think administration is evaluating that option. I think administration will stay focused on making sure that the cost to homeowners don't go high. I think within the current construct, there are ways to implement that reduce the government footprint but do not lead to full privatization. With that said, in an event of a privatization, we do think it will be associated with some form of guarantee for agency mortgages, which essentially would mean that the agency mortgage spread will not be negatively impacted. In fact, the removal of that uncertainty may even turn out to be positive. So we remain actively engaged with the policymakers on this, but we don't think that is a scenario for spread widening in agency mortgages.
Okay, great. Let's do another one to you, Mohit. This one's around the global reserve currency, so the dollar. Does PIMCO think the euro has the potential to gain prominence as a global reserve currency at the expense of the US dollar?
That's an interesting one. So I think when we think about euro as a reserve currency, a few things stand out. First is I think euro certainly has the GDP and the rigor of the institutions to be a potential substitute. However, there are a few things that work against the euro. First is that because of idiosyncratic nature, there is less cohesion between the member states. So that's the first one. Second is, similar to the policy of US, euro follows somewhat similar foreign policy. That means that those worried about, basically restrictions may not get that diversifying away from USD into euro. And then the third is that when you look at the usage of euro in trade flow, it has actually come down. So net, we don't think euro would be a kind of a viable or a stronger substitute for USD in reserves. We do think under a kind of a lower trade regime induced by tariffs, the aggregate level of reserves will not grow or even shrink, which means that the US role in the reserves will also come down.
Got it. All right. Let's close this out with a question to both of you. Tiffany, let's start with you. What opportunities are you most excited about in markets?
Well, I think that we've made a pretty big case for fixed income, so I'm just going to underscore that. It seems to me, the focus here is just that fixed income is paying you for stability right now, and that seems like a pretty good opportunity. I don't think you really need to reach further than that.
Mohit?
Yeah. So I think two things. First, I would echo with what Tiffany said, and I would even go a step further and say that over the next 3 to 5 years, I would assign a meaningfully higher probability of investors getting superior returns in fixed income relative to equities. And then the second, risk-adjusted returns in fixed income relative to equities. And then the second, I would say, is that this volatility is creating incredibly high amount of alpha opportunities in fixed income. I think we are seeing that through divergence. We are seeing that through regular volatility. We are quite excited about this alpha opportunity set. And I think investors can kind of get that incremental alpha by going from passive into more active fixed income in this kind of environment.
Yeah, uncertainty is creating a lot of dynamic, interesting opportunities. Mohit, Tiffany, thank you. Let's leave it there. First, I want to say thank you to all of you, our clients, for joining us today.